I've been asked to introduce the C-Suite Resilience panel today. I'm Phil Klotzbach. I'm a research scientist in the Department of Atmospheric Science at Colorado State University. Our group's best known for the seasonal Atlantic hurricane forecasts. So I've been asked to kind of introduce this panel on resilience. I'm going to focus on the natural catastrophe side of things, since that's kind of what I do primarily. But obviously, when it comes to resilience, we need to be resilient against man-made perils as well, such as we heard earlier about cyber and terrorism and all these other things that come down the pike. But speaking of natural catastrophes, really 2021 certainly had its fair share. When I was going back kind of preparing this talk today, I said, I was kind of surprised to see that cold air outbreak was actually in 2021. It seems like that was 5 years ago now, but that's kind of the way the year really got kicked off from an AtCat perspective. And I think to think that basically a cold air outbreak would cause $20 billion in damage is kind of mind-blowing. And it highlights the fact that it was a pretty pronounced cold air outbreak, but we've certainly seen cold air outbreaks of comparable or even stronger magnitude in the southern plains. And the fact that it caused that much damage really highlights that we need to have a resilient electrical grid, because obviously we had electrical failures and a ton of burst pipes, and obviously we saw the damage that came from that. And there was also a lot of damage in the agricultural sector. Then it came, as always, severe storm season, usually peaks in the spring, and we had, it wasn't like we had one particular catastrophic event that caused a tremendous amount of damage, but severe weather is often basically categorized as death by 1,000 cuts, and really that was the case this year. Severe convective storms, that includes hail and tornado, and straight line. Basically, we ended up with $30 billion in damage from severe convective storms, and most of that was insured, over $20 billion. So just pretty much eye-popping, given, again, we didn't have one particularly cataclysmic event, but just, again, many 500 million to $1 billion losses. So I think at some points it's been called a secondary peril, but certainly when you're talking $30 billion a year, that's certainly not secondary peril kind of material. Wildfire, again, a really big year for wildfires. As Sean mentioned, when he opened today, we saw over 2 million acres burn in California this year. 1 million acres alone were basically burned by the Dixie Fire. That fire lasted 4 months, so while the fire itself caused about $1.5 billion in damage, it was an eye-popping over $600 million in firefighting costs. So, we always think about the damage that these fires cause, but then you have to think about the costs that are incurred in fighting these fires. And then what I really work on is the Atlantic hurricane season. It was another above average hurricane season. If we talk about the number of storms, it was extremely active. We had 21 storms this year. That's the third most on record, trailing only last year, which had 30, and 2005, which had 28. But it was more than just the number of storms. Sometimes can be a little bit of a red herring, because we are naming more weak, short-lived storms than we used to. But if you look at the overall number of hurricanes, we had 7, which is basically the long-term average, and we had 4 major hurricanes. An average season has 3. Major hurricanes are hurricanes, category 3 to 5 hurricanes, winds of 111 miles per hour or greater. While they only make up about a quarter of all storms in an average year, they do about 85% of the damage. And obviously, one of those major hurricanes was really the big story this year, and that was Hurricane Ida. Powerful category 4 hurricane, slammed into the central Louisiana coast, caused a tremendous amount of damage from both storm surge, strong winds, and heavy rain where it made landfall. And obviously, any of you that were in the mid-Atlantic states, or if you're in New York City or anywhere near here, we saw several days later, once the storm had dissipated, its remnants interacted with the frontal system and obviously caused a tremendous amount of flash flooding, really kind of highlighting the fact that these storms are more than just coastal events. They can certainly cause impacts well inland. Ida was also very, very powerful. Its max winds were 150 miles an hour at landfall, which ties it with Laura from last year, as well as the last island hurricane of 1856. For the strongest hurricanes on record to hit the state of Louisiana by max wind. Records for landfalling hurricanes go back with reasonable accuracy back to about the middle of the 19th century. And so really, while that Ida was a damaging and devastating storm, we did dodge somewhat of a bullet in that it basically only grazed the New Orleans metropolitan area. Had Ida made landfall, say, 50, 100 miles farther to the east, it would have been a much, much stronger hit to New Orleans. Thankfully, the levees were tested fairly significantly. They actually did hold up quite well, so hopefully that's encouraging if another big storm actually does hit New Orleans more head-on. In addition to those storms, we had 6 other named storms, 1 other hurricane, Nicholas, make landfall. Elsa and Fred also brought pretty significant flooding well inland, and again, highlighting that these hurricanes are coastal threats, but they can also be threats well inland. There's obviously a lot of debate in the scientific community right now as to how these perils are going to change, but one kind of recurring theme that we can talk about, especially with hurricanes and wildfires, is that we have growth in population in areas that are significantly impacted by these threats. So you just have increases in exposure. So for example, if we look at the number of hurricanes that have made U.S. landfall, the number of major hurricanes that have made U.S. landfall, we don't see any long-term trends. But if you're here for the first talk and looked at Sean's slide, you see these huge increases in damage from these storms. And most of that to date is driven by changes in exposure, just more people, more stuff in harm's way. Similarly with wildfires, more people moving into that urban wildland interface, again, really causing the potential for increases in the damage that these systems or these weather phenomenon are likely to cause. When it comes to climate change's impacts on these various perils, with hurricanes, they're likely to become maybe a little bit stronger. It's not a super straightforward relationship. The reason being is that you warm the ocean surface with global warming. That's a plus for the hurricane. It helps it get stronger, but you also warm the upper atmosphere, so 20, 30,000 feet. That tends to stabilize the atmosphere and potentially take out some of the additional strengthening. But even if storms only strengthen a little bit, the big concerns that we have are, we know with global warming, the sea levels are rising. And so for basically then, if the storm doesn't change at all, the storm surge, so that wind-driven increase in water level that you get when a hurricane makes landfall, can penetrate farther inland. And as you know, it doesn't take 6, 8 feet of salt water in a house. 6 inches to a foot can be enough to condemn it. So that sea level rise makes for further inundation of that storm surge. Also, with a warmer atmosphere, we're likely to see more intense rainfall. Just because a warmer atmosphere can hold more moisture, and that holds for severe convective storms, hurricanes, as well as other just simple mid-latitude systems. Likewise with wildfire, as we get warmer temperatures, that can tend to dry things out faster, exacerbating wildfire risk. Potentially also more significant droughts that could also pose problematic. So we have all these various features that we have that we're really looking at when it comes to how these perils may change in the future. But regardless of that, I think one of the things I always say with hurricanes is we're not even really prepared for what we've seen in the past. As Sean mentioned earlier, we had 5 Category 4 hurricanes hit South Florida in 6 years in the late 1940s. Obviously, if that comes around again, there's a whole lot more people and a whole lot more stuff in that area than there was, in the late 1940s. So that's really what we're going to be focusing on today, is basically how we can be resilient to these perils in future years. And so now I'd like to welcome to the stage the moderator for our C-Suite Resilience panel. His name is John Huff. He's the president and the CEO of the Association of Bermuda Insurers and Reinsurers. John has spent his entire professional career in the insurance sector. Prior to his current position, he was a director of the Missouri Department of Insurance, and he was also the president of the National Association of Insurance Commissioners. John's also served as an executive for various leading insurers and reinsurers in the US, the UK, and my favorite vacation destination, Switzerland. He holds a JD from Washington University School of Law. So please join me in welcoming John to the stage.
You've made it to the last panel. Congratulations. And let me thank Phil for the introduction. I can assure you we were in the hallway and we heard not one word of it. So if we say anything contradictory, please correct us. I do want to give Phil a shout out. And if you do not follow him on Twitter, he is probably one of my best follows. He's nearly 52,000 followers, and particularly during the hurricane season. So I'm going to give him a plug. He's at Phil Klotzbach. And if you pull him up on your Twitter account, you'll see his jog this morning in Central Park as well. So I enjoy his work and appreciate everything he does for the industry, and particularly, again, during hurricane season. Let me thank Sean and the III for hosting the event. It's good to be back in person, isn't it? This is a relationship business, and I've enjoyed visiting with people, and the scale seems right, and everyone seems very respectful of meeting people where they are. Hopefully Phil gave you a little bit about my background, but I came to the industry from the reinsurance side and then became a regulator, kind of did it out of order, and now I'm with the Bermuda market and proudly represent them on public policy issues. But we've had a year, and Bermuda's known for the nat cat space, natural catastrophes. I always say we were climate before climate was cool. We always followed the risk transfer of natural catastrophe risk. And this 2021 has been a year of risk that has certainly challenged us. 18 events in the U.S. alone, over $1 billion an event. Just a few years ago, those types of numbers would be unheard of, not to mention the 538 deaths and significant economic losses. New market data indicates our market, just Bermuda alone, has paid nearly $500 billion since 1997 to consumers in the EU, the UK, and the US. So our scale for our industry is reaching heights that would have been unheard of. I've done a couple of interviews since I've been here, and I know these CEOs have been on the interview trail as well with some of the press partners that are here. And everyone's asking, what's important to your market? What's top of mind? And what my response is, what's top of mind to our market is the same thing that's top of mind to global economies. And I'm putting it in the categories of the 3 C's I've been saying: climate, cyber, and then capital, and then you could throw in another C for COVID. And I know I'll be interested in perspective here, but our goal today is to talk about resilience, but maybe a little bit more broadly than we've ever talked before about it. And it's more than just resilience in terms of recovering from one of those events that always shape the future of our market. We have an all-star CEO panel today, and I'd like to thank them all for joining us. And I'll introduce this way from my left, Rich Creedon, who's CEO of Utica Mutual, and he and I share that we're former claim guys, and we always say we're the smartest in the room for the industry, because if you don't know where the money goes out, it doesn't matter how much money comes in the organization. And then Paul Horgan, who I had a pleasure of visiting with a few minutes here before, from Zurich, and will certainly bring an international perspective, and he leads the national accounts, head of U.S. national accounts for Zurich North America. And John Smith, who's CEO of Pennsylvania Lumbermans, will give us that perspective. And Rohit Verma, who also has that claims background and sees it every day, and will interested in his perspective. We're going to kick off and talk a little bit about resilience. We think of it in terms of preparedness to meet and even rebound from large single events: hurricanes, wildfires, earthquakes. But it seems we may have entered a new period for leadership and CEO leadership, that we should be thinking about resilience more broadly. And I'm thinking in terms of interconnectedness between business and individuals and communities, through technology and global commerce, through supply chains and labor force disruptions we've experienced during the pandemic, cyber risk, which is such a growing market for our industry, but also growing risk for our global economies, and it's irrespective of where those risks come from, whether there's political bad actors or just unforeseen circumstances. But I'm going to kick off with, and Rich, I'll kick off with you. Have risk and resilience fundamentally changed in recent years, or are we just having to adjust viewing risk through a new lens?
Well, there's certainly a lot more to think about, that's for sure. And I think historically we've thought about it through the property line of business, but now you look at casualty, specialty. There's just stress points, on all of those business segments. And when you start thinking about your perils, wind and flood and pandemic and cyber, they all, are implicated now in resiliency concerns. And I think probably the change, really the kind of the opportunity moment for us, is that there's market need and there's expertise we have to maybe expand beyond just the traditional, product risk transfer product, and really focus on services and what we can do to support insureds and policyholders with risk management, loss control services, the things that can really augment, our risk transfer capabilities. You look at how we typically view these things. I think we've thought of them in balance sheet terms, right? We're collecting and building up large reservoirs of capital and surplus for that large capital and surplus draining event that's going to happen. But nowadays, capital is fairly cheap and abundant. It's almost a renewable resource in the environment we're in right now. And I think that kind of makes the risk transfer product more commoditized. It sort of becomes a race to the bottom on pricing and product. But with the ability to add services and to really impact insureds and business owners and consumers in the daily cadence of their life and managing these kinds of exposures, I think that's really where there's sort of a leverage point and opportunity to do something really impactful. And I think for a couple of reasons. One, it's more capital efficient to be using those kind of resources, in a services way. But secondly, it also helps to accelerate the product development life cycle, right? That, you think about, some of the things you talk about, supply chains and political mandates. Historically, we're kind of slow at developing the products really to respond to those things, and it's just because we don't have the loss tables and the loss history to be able to develop and price those products. But I think the expansion of services can really, help us extend that, that product life cycle, develop it more quickly, and really, as I said, make an impact with consumers.
Mm-hmm. Rich, I think you've really hit on something, because I feel this move for our industry of going from insurance to protection. And as a former regulator, people used to come to my office all the time and said, this really isn't an insurance product, it's protection. And I always said, we don't have that flavor here. We only regulate insurance. But I think you're hitting on something that we're seeing in the industry. And John, I'll ask for your perspective from Pennsylvania.
From my standpoint, risk is evolving. If you think about this meeting 20 or 25 years ago, we would have called into our offices once or twice during the day, maybe picked up some messages, and today we have this thing in our pocket that connects us all 24/7. The complexity of risk has dramatically changed. Think about the topics of today, right? ESG, cyber, diversity. They're all aspects of the business world that we have not dealt with over the centuries. And I talk about centuries in the insurance business, right? I run a company that focuses on building material dealers and sawmills and light wood manufacturers. And as a result, I understand pretty well the supply chain. And some of the topics we talked about today, new home starts as opposed to new home completions and those type of things, that's second nature to us. But it's not to most people that are not deeply involved there. We talk about storm surge and the follow-up on losses and how much they're growing up, right? Well, that's good for our customers when that happens, right? We are that demand surge that occurs. So it's not, in my mind, a fundamental shift in what defined as risk. It's the fact that there are so many more that are coming at us today. I mean, think about for just a second the business interruption form. Always a difficult claim settlement. Always has been a difficult claim settlement. And now we have people questioning the validity of what is really covered. And I don't know about my fellow panelists here, but what we're seeing is that business interruption claims in the past, it was a tough part of the settlement. If you had 3 million of coverage, someone submitted $1.5 million, you'd work your way through it. You might pay $1.5 million, you might pay $1.6 million, you might pay $1.3 million, right? Today, they're coming at you and saying, that's a policy I'm cashing the limits in on, right? And that's a different environment that you're working with. Same thing with the casualty litigation that you're seeing in the panel that talked about before. So as I think about risk, I do a lot of listening. That's why I'm here today. That's why I'm part of the III, right? Because I want to have different perspectives thrown at me. I want people to talk about what they're seeing so that I can try to build it into our model, into our ERM program to understand what's happening and how it's evolving. So.
Paul, let's bring you in here. What are you seeing? What's the industry doing well, and what can they do better in terms of resilience?
Yeah, John, I think, in terms of what's the industry doing well and resiliency, I think for us, I think most of our companies is first and foremost is focusing on us as an individual company. What are we doing as in the resilient space? And for Zurich, I think we have a benefit, and I'd say a European based company. They've been focused on climate change and these things for a lot longer time. I mean, Zurich's been monitoring its environmental footprint since 2007, has been like net neutral since 2014, has signed on to the UN agreements. These are things that are hotly debated in the US, but they're buying in, they're flowing through. And as a result, we as a corporation have made commitments on where we're going, have short, medium, and long-term plans, both with ourselves and what we'll ensure going forward. And it runs the gamut from, how much travel we do. We've committed to reducing our air travel for non-customer businesses by 70%. We're starting to convert our entire fleet from gas to electric. We're starting that in the 23 year, and by 25 we should be all to electric and/or hybrid, where electric doesn't make sense. Those are the types of things. We're investing in a forest in Brazil where it had been transformed to a farm. We're repopulating with indigenous plants to bring that back to life. So first is get your own house in order and work on it. The second is our customers are craving for insights. You're exactly right there. This is an evolving risk, and some of it's insurable, some of it's not. But they are looking to us for data. They're realizing now with the pressure from the government, from their investors, from society, they know where they need to be, and they've got this journey to get there. And so what we've had to do is, work with meeting our customers where they are and trying to help them live into that expectation of sustainability in their organization. So we've done that. And the last thing we've tried to do, again, and as I think about 3 pillars, is that it is a societal issue where there's government requirements and government engagement to make the country more sustainable. So we have been investing in a partnership right now with cities, with Boston and with Houston, working on resilience and equity in their communities and trying to see if there's a way to harden them and make them better communities to face the pressures we're facing today, take those best practices, and then see if we can export them across the rest of the country. And so for us, I think it's really been 3 pillars. What are we doing personally? How do we support our customers? And then how do we engage? But all 3 are critical for us as we think about being part of the solution as we go forward.
The interesting thing there is that as you talk about, becoming more sustainable as a company, right? Many people object to government pushing their way in and saying you need to be more sustainable. The fact of the matter is we're going to get dragged there by this next generation, yes. Right? And it's not going to be government that's going to drag us there. It's going to be the next generation of employees that want that want to be part of that. And I think that's an interesting dynamic. As an old guy, a lot of the topics that we talk about today, right, are very foreign to me, right? But the fact of the matter is, I think as we as an organization have changed and embraced those things, we've become stronger, and we've become a better place to spend a career and invest a career, and we're pretty proud of that. So, I'm sorry for jumping in.
Rohit, let's bring you in and get some perspective.
Yeah, look, when I think about resilience, I think about resilience as being able to recover from an adversity, able to recover from a loss, or prevent that loss from having any impact on you. So, and I think that if I look at the industry, frankly, it's impressive to see what the industry has done, right? Paul talked about the partnership that they've had with Houston, with the city of Houston as an example, or I know Zurich's done some work in New Orleans as well. I think where there is a gap is that there is, if the industry were a playing field, everybody's playing like a quarterback. And if everybody plays like a quarterback, you can't win. So my concern is that we as an industry, are we coming together and really rethinking the ecosystem of insurance, the brokers, the claims providers, the carriers, and thinking about how do we align ourselves best to actually have a meaningful impact on resilience. This morning there was a lot of discussion on the education and awareness. I think in the first discussion that Sean had about education and awareness of a consumer. Who's responsible for that? Who's responsible to ensure that people are making a right decision? If I ask people in this room to raise their hand and say, how many people have experienced theft? Probably a handful of hands will go up because they've experienced it. And if I ask them how many people have an alarm system at their home, a lot of hands will go up that they have alarm system. And if I just change that and I say how many people have experienced a water loss in their house, a water leakage, a water damage, I think a lot of hands will go up. And if I ask them how many of you have a water leakage detection system, only a handful of hands will go up. So I think there is a gap between what we perceive to be risk versus what we are actually protecting ourselves against or being resilient on. And then I think there's a gap for us in the industry as to how do we rethink the ecosystem, the entire value chain from starting with the broker all the way, if I take property, all the way to the contractor. How do we rethink that value chain and ecosystem to truly be resilient? And I think that's a very big gap. So we're all playing quarterback as a quarterback right now, and until we keep doing that, I don't think that's going to have a meaningful impact. And to put a plug for Sean, I think III can actually play a role in aligning that value chain of the industry to do something. And I was not paid for that, by the way.
And let me give another compliment to III. I thought Sean did a particularly good job today explaining what we can do and what we can't do as an industry. And I think sometimes, certainly not this panel, there are industry leaders who try to say that we can solve all the world's problems, and we have to put our place in perspective, and it's important, I think, for our own reputational risk. Rohit, I'm going to stay with you for a minute and kind of get a little bit more technical. We have some supply chain issues. We have an inflationary time by any description, and there's some loss drivers here. And so, how do you see the industry pricing and dealing with claims in this type of environment, and what should we be doing in that regard?
Yeah, look, at the risk of sounding irreverent to my actuarial colleagues, the insurance economics is actually pretty straightforward, right? You try to get a bunch of risks together, and you write a bunch of risks, and then you hope that only a fraction of those risks actually come true, and that's how you make money as an industry. And when that small fraction becomes a large fraction, then the product becomes insolvent. And I think what we're seeing, whether you take COVID or whether you take cyber or for that matter, catastrophe, these risks are truly becoming much larger, and the fraction is becoming a much larger fraction. And we in insurance have, for a long time, have had the tradition of looking at patterns and then assessing risk based on patterns. And I think those patterns are getting disrupted. We saw that kind of disruption in D&O back in 2008. We're seeing that kind of disruption now in catastrophe. We're certainly seeing that kind of disruption in cyber when there is really no pattern for you to predict, and based on that, price it. So I think given how we price, given how we reserve, given how we pay, that is going to be a challenge. And whether you can use data or not, I think still is a little bit up for grabs. I think data can solve a lot of issues, no question about it. But again, data is looking at what has happened in the past. And so all the data is doing is looking at patterns which have already happened. And if those patterns are disrupting and disrupted, then are those patterns still going to hold true or not, I think is still a question mark. And look, as a claims organization, we feel our purpose is to restore and enhance lives, businesses, and communities. And what we stand ready for, that when that disruption does happen, then we are there. But I think, rightly or wrongly, the onus is going to lie a lot on the underwriters in how they think about these emerging patterns and how do they price for these emerging patterns. Because if the whole business interruption thing would have gone through, we wouldn't be able to sit here because our industry will be out of money paying for that. So I think legislation, underwriting acumen or underwriting insight, and then followed by claims has to really come together to figure out how we're going to handle these issues that are emerging, particularly which are causing what I call systemic risks.
So a fascinating topic. John, I'd love to get your take on it, and others as well.
From a claim standpoint, claim costs, we're very intuitively aware of that, not only just from a claims aspect of the claims we handle, but because that's what our insurers do, right? So you've read about surging lumber prices, right? Everyone's talking about surging lumber prices. Two types of lumber in the world: softwood lumber, which you frame with, hardwood lumber. Hardwood lumber prices based on the species and the number of knots and all kinds of good stuff, right? Softwood lumber is priced on demand, okay? But the claims costs are not going to increase in buildings just because softwood lumber is up. The price of building materials across the board are up, right? So whether it's copper, whether it's the porcelain fixtures, I mean, the whole house is becoming more expensive to build, the whole structure. And on top of that, you know, try to get a contractor today. You talk about earlier, we talked about finishes as opposed to starts and the supply chain, how that's slowing down. I would submit to you that's only part of it. The other part of it is that you can't find people to swing hammers, right? And when you do find them, they don't want to work for $15 an hour. They want $25 an hour, right? Which I think is going to take care of the minimum wage problem we all deal with in the country as well. We're not going to need to legislate that either because we're going to have to raise wages to attract the type of people we want to attract, right? So then you look at the medical side, and then you look at what it takes to repair an auto today. So you got this tremendous increase in claims costs that are coming at us. And I don't know that we've actually, you know, factored that into all our pricing and the actuarial side of the coin either. So I think there's going to be a lot that has to happen there. I know as I looked at some of those charts this morning, the price targets that we've set for 2022 are underneath some of those numbers. And I would submit that many are in the same situation, right? And we're going to have to figure that out, right? Because if we have that kind of inflation, how are we going to do it with not enough premium coming through the front door, right? Then you add in things like, you know, think about those most recent storms, right? When you get a hurricane, we've all had problems when a regulator, rightfully so, says, you know what, don't cancel anything for non-payment. I get it, right? And it's 6-8 states, right? How about 48 states? I would bet anybody who's running an insurance company 2 years ago in March had a big concern for cash flow, right? A tremendous concern for cash flow. Never had that problem before, right? Because we had state after state after state doing things. So resilience comes in a lot of different forms. And again, it's up to us as leaders, I think, to try to project what they could be. And it's not, you know, we talk about wildfire, right? So we all have wildfire models, and we all run the wildfire monitors, and we put wildfire deductibles in, and we put in, you know, facultative reinsurance buys. I'm not concerned about the areas where wildfires are going to occur that we know about. I'm concerned about South Jersey, 100,000, you know, square acres down there of pine trees that are 10 feet tall. No one's talking about that as a potential exposure, right? So where are those things going to happen? Anybody here would have projected Texas freeze? Well, where's the next Texas freeze? That's what I think we have to think about. That's what I think we have to come to terms with and understand and try to add value to. So.
Paul, I don't know if you want to chime in here. It's interesting because these are challenges for us and for our industry, but in many ways, maybe these are our opportunities because the uncertainty and risk is when we do better, right? People understand our value proposition a little bit more clearly.
And I think a couple of things. One is on the inflation side, you know, John, I think one of the challenges is we're all kind of become lax on looking at that exposure. Sure. Not just us, our brokers, our customers knows how to think about it, the valuation of what's a building cost, what's a replacement cost. But we did a review of our sampling review of 10,000 locations. We had over 10,000 locations in property where valuations hadn't changed in 3 years. That's an underreporting of exposure, an under expectation of exposure that we now are very much trying to educate our underwriters and clients to start thinking about, hey, the world has changed. Do you understand what's happened to your risk, that if your building burns, it's going to cost you 10, 15% more to build it or more, that if something happens during an event, your business interruption is going to be longer because the supply chains are challenged. And do you have that built into your program, your thought process? And I would say all of us have just become very lax because that isn't the world we've been in the last 20 years. Mm-hmm. In general, you know, we look at it, and as risk rises, it tends to be good for insurance industries because it's an opportunity for us to deploy our capital and to bring our expertise. As Rohit was saying, the challenge is when risk, you know, it doesn't go with the many paying for the few. That risk becomes systemic and goes everywhere. And that's where we do need to partner with government in that space. And I think the pandemic's a great example of that. You know, for Zurich, we've talked about the need for a federal solution. We've proposed something along the lines as what we use in the crop, that they use for crop insurance. We think that's a good mechanism to have a public-private partnership in that area. But there's other examples out there where, kind of a TRIPA type of a solution. And the key to that, I think, is we do need to get ourselves more resilient as a country, and we think it's important that that type of legislation, we rally around an answer, and I think all of us are open to the right answer, but I do think we need to get ourselves positioned so the next big event that occurs, we actually are prepared to deal with it. So it is something that's front and center as we think about it.
Yeah, there are a lot of views on future pandemic, but I have heard some pretty strong arguments that we do have to remember that we're in the risk business, and that if there's a move to go to just a fee-based business, that changes the perception of our industry a bit. So we have to take all into account. Rich, I don't know if you want to chime in on that one, or if you want to start talking about talent.
Yeah, well, I guess just thinking about the auto business, personal and commercial, I think it, probably, has kind of set a path for us for things that can help with the inflation trends you talk about. Auto material damage, there's labor, parts, materials, shortages, et cetera, and that's certainly impacting pricing. I think that kind of severity trend is probably, going to level out at some point. Things will ease up as supply equals demand. That kind of usually gets back to normal and equilibrium. I think the concern, though, of bodily injury severity trends, I think that's a longer term trend and a more kind of intractable issue we're really going to have to manage and work with. And it's because of legal involvement, lawyer involvement, and litigation, and the frequency and the volume of litigation. Litigation is ultimately just an inefficient, really just not high cost, inefficient way to resolve disputes, resolve third-party claims, and I think we really have some work to do as an industry, to try and fix that. I'm a lawyer by background, by training. I think jurors generally do the right thing. I think for the most part they take that role of arbiter of justice seriously, do it right, do it well. But again, the problem is it's a high-cost, inefficient way to do things, and for us, I think the challenge is, how do we convince people that's sort of a path of last resort, right? That's a resolution track that when all else fails, you should pursue. And this is where I think the lawyers out there have really, I was at a trade association recently, somebody said they have a 40-year head start on messaging, right? That the message is out there, that courts are open and available and accessible for everybody, and people, I think, feel comfortable with that. So it really means we've got to kind of play catch up with our messaging and our managing of this exposure. And I think that means, one, we need to find tools and ability to more quickly resolve these kinds of claims to keep the severity in check. Even with all the tools we've come to develop in recent years, you think about, getting records and, reviewing them, inputting into systems and authority, negotiations. It is a slow process by the way you would think technology, the standards we expect today. And I think consumers react and respond to that. Just the basic empathy factor that we should be presenting to the consuming public. I mean, we have a great tradition in our industry of really helping people when they're at their worst recover from really disruptive events in their lives, and I just don't think we're really sort of messaging and communicating that well enough. And then lastly, I think ADR really, needs a reboot. We have a lot of, different techniques out there, but, they're cumbersome. They're not friendly. They're not consumer friendly and easy to access. They're kind of intimidating, I think, out there for the public. So I think we need to really work on those tracks as a way to get that BI severity under control and take hold of the settlement process, ourselves again, instead of ceding it out to lawyers.
Rich, I really
Can
enjoyed.
I just add something,
Please go ahead.
John, because one thing that I feel like just going on messaging, there is the piece of messaging that has to come out that educates and lets people know that as these things go, right? So what have we seen? We've seen deductibles on property go up, right? What have we seen? We've seen terms and conditions on cyber get a lot tighter. And what's happening is that the whole value proposition of the industry right? Because at the end of the day, we as an industry have to make money, right? It's a for-profit industry. We're going to just curtail the amount of insurance that we actually give out. And what we're doing as a result of that is actually creating more uninsured and underinsured risk. And is there anyone who's actually seeing that and observing that and communicating that? That if we don't figure out a way to manage these things, if we don't figure out resilience, if we don't figure out how to reduce the social inflation aspect, then what's going to happen is the insurability is going to get lesser and lesser. And that, frankly, exposes us to a much bigger risk from an economic perspective. And I think that piece of the messaging is equally important, which is missing.
It's interesting. I'm sometimes asked to do speeches or welcomes to new insurance commissioners because of my former relationship with the NAIC. And what I tell the new insurance commissioners, you should always be concerned about the affordability of insurance in your market, but you ought to lose sleep about the accessibility of insurance in your market. And as soon as you think you can go in and over-regulate to get people to write business is when you're going to be very disappointed in your options for your consumers. It's a big concern. And I've enjoyed the litigation panel here, to your point, Rich, because this analytics on litigation, I think, is something that is past due, and maybe we've had a little bit of pause on it. But I'll tell you a 10-second anecdote. I was a law clerk for a trial judge when I first got out of law school. And the judge and the court reporter and I would bet who the jury foreman would be. And at the end of my term there, I was successful and won every bet. And finally, the judge says, how are you doing this? Because are you spending more time with the jury? What's your key? It's whoever organizes the donuts and the coffee in the jury room. And it really is true. It's and there's some analytics there of who has these leadership traits to take a little bit of charge when they get back there with those confusing jury instructions of say, this is what I think we should look toward. Anyway, it's a fascinating area, and I agree with you on the litigation fronts. But I do want to talk about talent. Some great discussions already earlier today, but this great resignation, I was probably slow to feeling it, and probably many of you felt it earlier because you have large teams in your organizations. But I'm interested in your take on it, particularly on as insureds. Is it more risk for insurance companies because they have thinner staffs and perhaps not doing the work they need to do in a safe manner to deliver goods and services? And then how is it affecting how we work, and particularly in your own organizations and in the underwriting process, particularly at certain times of the year, and then the claims adjudication process, which is so important for timeliness. So Paul, maybe we'll kick off with you, and then Rich, go to you for your perspective.
Sure. But yes, absolutely. There is a war for talent out there, and we have seen the Great Resignation. We've also seen the Great Retirement. I mean, this industry is an aging industry as well. So there is a double barrel coming at us in terms of our need to attract and retain talent. And what we've really been trying to do in that space is we have to broaden our talent pool. And one of the things that we've done, or some of the few things we've done, is first off, we've started an apprenticeship program that was really cutting edge at the time and really started to attract people who weren't attracted to this industry right out of high school or trying to change careers, and supported them with a program that they were able to work for us for a couple of days, and we would pay for their associate's program. In 2 years, they came out with an associate's degree, no debt, and a job with Zurich. We've now expanded that to multiple cities. We've also partnered with other financial institutions to build this out. And so that's been a real win to attract more diverse talent. We've also very much been interested in expanding our pool of talent and being much more transparent as to where we are in that journey of being diverse and inclusive. We now publish all of our stats publicly as to what is our diversity, male, female, and people of color, and not just in total, but also by job descriptions. And not that it's perfect, but it's something that we're doing. And again, it's a way for us to hold ourselves accountable as we go out to attract talent and make sure we're working and showing progress in that area. And one of the last things we did, most recent that we think were exciting, is that this is a great industry. And we think this industry can compete to attract talent compared to other industries. So we we've now developed and implemented a professional onboarding program, which we feel like we have a good entry-level strategy with apprentice and college recruiting in diverse areas. What we've now done is put a program in place where we can get halo industries and pull them in with, right now I've got over a dozen roles that we're out in the marketplace for where it requires no prior insurance experience. It's skill-based, and we're going to take them in and build up their insurance skills. And we think the story of the insurance career is a powerful one that allows us to compete with other industries. And so we're looking for that really to attract the talent, to maintain the talent, and again, have us ultimately pull that talent and have talent that looks and feels like the communities that we live and work. But it's a journey, and it takes a lot of effort and a lot of focus, but it's necessary because of the resignations and because we're in an aging industry.
Mm-hmm. Rich, how are you tackling it?
Well, we're seeing all the same issues that wave of retirement from the baby boomer generation that's run our industry for so long, and having to replace it with, the next generation. And, one of the things we're focusing on is really trying to message, the kind of opportunity you have here, the normative foundation of our business, the values of working to help people. We talked earlier about trying to trying to help people who been injured and had their lives disrupted by events that we're there to help support. And I think it was in the last group, I think it was Victor maybe talked about doing something that's bigger than just yourself, having a mission and a sense of purpose that is just a little bit beyond maybe your own comfort level. I think that really is helping us reach people that would not otherwise have thought about insurance as a career. And so we've been finding that just the quality and the volume of people that are interested is really surprising. We've got great people coming up in our industry. I feel very optimistic about the future of our business because of that and the efforts we're making. But once you get them in the door, I mean, we really have to get people developed fairly quickly. For us, we've gone to, I'll just take our claims department. Every single knowledge worker has a detailed, written, individual professional development plan. And it's reviewed every quarter with their leader, and it's adjusted and it's tinkered with. And, that includes all the things like all the institute's programs, the SLA, AIC, all those. But it's also very much a mentoring kind of program where they're assigned to a mentor, so they learn sort of the soft skills, to get to the next place in their career. I think we're seeing that you can't have a sort of just-in-time sort of personnel delivery kind of system, right? You can't take somebody who's been 3 months in a training program and plop them down onto a professional liability kind of desk. So you have to have a long professional arc and a consistent commitment to the individual's development. And I think that really gets you to that discussion where you're looking at that person as an individual, not just a resource, but really an individual, and how you can make them feel they perform their best in your environment. That's the key to, I think, retaining people and growing and developing the next generation of staff.
Go ahead,
Yeah.
please. After you.
Go ahead, John.
I'm just finishing up going through the chairs at Gamma Iota Sigma. So I'm intimately familiar with what's going on in the risk management programs throughout the United States. And I'm also on the advisory board for Temple University, which is the largest risk management school in the United States. And we're very heavy into internships for a small company, I think. Nothing I'm sure the size you gentlemen have. But the other thing we do, and sort of interesting, is that we got aligned with a high school in Philadelphia, which is part of a chain called Cristo Rey. High schools are coming up in underprivileged areas, bringing in the students that normally wouldn't perhaps have an opportunity to move on to a college or a professional life. Mm-hmm. And we're getting these kids as sophomores. We have 5 of them in the office, sophomores, and we bring them back, and they come in 1 day a week for their entire high school career. Then we offer them internships, right? They're with us during the summers. We offer them internships in college. And it's an interesting way to get a diverse look at young people coming in, and our employees feel good about the fact that they're helping out, right, in the community. And it's interesting that we have our first young man will be joining us in January, who started with us 8 years ago and went through St. Joseph's RMI program, and will start with us in January. So it's helped us sort of address that young people coming through. You know, if you think about Pennsylvania Lumbermen's Mutual, it's a little tough to compete with Zurich, right? You know, or Hartford, right? But we do, and we have a lot of things we can offer to young people coming in the front door and expose them to many things. For instance, I've got 3 of our young leaders with us here today, right? Because I want them to rub elbows with this group of people, you know. So we try to do different things to make that more viable for us. To me, the Great Resignation, I can still remember before we called it the Great Resignation, 7, 8 months ago, whatever that might have been, when we lost one of our key players. We just decided he had enough, right? And what do you mean you've had enough, right? I'm going to do something different. What do you mean you're going to do something different, right? I'm not a lawyer, right? I'm an insurance guy, right? I came out of college. I joined the insurance business. I've been in it forever, right? And I love it. I think it's a great industry. But so I don't understand when people, I'm going to do something else. But you know what? The Great Resignation, what we found is, yeah, we're losing people. We're having senior people go on vacation and not coming back. But we're having a much easier time hiring people. Because, you know what? Your guys are willing to listen to an offer from a different firm today. So we're starting to see the backside of that Great Resignation, which is sort of interesting. And I'm not sure where that dynamic goes, but it allows us to sort of broaden our capabilities, fill gaps. So I think it's a churning. Now, the unfortunate thing is we're all onboarding a hell of a lot more than we ever have onboarded before. And if you're like us, we're still remote. It's a much more difficult thing to do. So diversity, it's you know, I've for years I've been in the mindset that I am not going to tolerate making a bad business decision. I'm not going to tolerate people in my operation making a bad business decision. And when you make a decision to hire somebody based on the color of their skin, where they go to church, whether they're male or female or any other factor along those lines, you're making a bad business decision. And we don't have a lot of time how we're going to deal with you there, right? We want people that they can do the job, and we don't care what they look like and who they are and whether they are straight or gay or whatever. What we're looking at is, can you do the darn job? Right? And as a result of that, our organization is very, very diverse. We're very proud of that. So.
Yeah. Rohit?
Well, I have a different perspective and on the Great Resignation. Look, I think for 2 years, we didn't have people wanting to move, right, during the pandemic, because everybody was afraid, okay, I moved during the pandemic, is my job going to go away, right? So that's one. I think the second thing is that while things are back to where we're meeting people outside, imagine if you had to go to an interview in 2018, you would have to take a day off from your work and tell somebody that I'm taking a day off. You would have to dress up, wear a suit, even if you were not wearing a suit every day to work. And then you would always worry that somebody's going to see you at that building and then call and say, hey, I saw Rohit outside the CNA office. What was he doing there?
Yeah.
Right? And by the way, I hope nobody from CNA is here. It's not like a bad thing to be seen outside the CNA office. But now, as Sean mentioned this morning, you don't even have to wear pants to go for an interview, right?
Or a skirt.
Well,
Preferably Bermuda shorts, at least.
right,
Yeah.
right. And then you don't have to take a day off.
Right.
You don't have to travel anywhere. You don't have the risk of being seen. So I think the general barrier to go somewhere has come down. So I think that's number one. I also think that a number of organizations have underinvested in training and development for years. Let's face it, so many times when there was a pressure from the CFO or the board or the CEO to cut down the budget, what did you cut? You ended up cutting down the trainer. You ended up cutting down a development program. So there's been years of underdevelopment in our industry. So when someone leaves, the only recourse that we as an industry have is to go get someone from the outside, from another company. We end up paying 5, 10, 15% more, drive the expense ratio for the industry up, because that's what ends up happening. So I think we have to make a sort of paradigm shift. I definitely think going to colleges is the right thing, but even in the college world today, there are colleges that are already rich, keep getting richer, and the colleges that are not rich keep getting poorer. So do we really have to fundamentally shift where we are looking for our candidates, right? Do we always have to look for the risk management candidate? Paul, you may recall this. This is a while back when we were looking for underwriters. What we found was that individuals with history major did a lot better at underwriting than individuals with risk management major. And we focused our efforts on hiring individuals with history major. So I think we have to rethink what pools we are getting individuals from. We have to rethink what colleges we target. And then we have to rethink what our priorities are that we as an industry, do we want to train individuals and get them ready and develop them? Or are we always going to say, okay, someone's left the organization, the only recourse we have to go look outside?
Okay, fire round. One word. What's the biggest because we're going to end on a positive note. We've talked about many challenges in the industry. One word, what's the biggest opportunity for our industry in 2022? This event's usually held in January, but let's just kick off to 2022. We'll start at this end and go to the end. One word, our biggest opportunity.
Cyber.
Tort reform.
Underwriting profitability.
There you have it, the last word. Please join me in thanking our CEOs.